Welcome to ListHouze. In this video, we will try to explore the 2026 Australian property market correction and housing outlook.
For years, the story of Australian housing was relentless resilience. Even through a cost of living squeeze, prices climbed and the boom seemed unbreakable. But by mid-2026, the momentum finally stalled. In July 2026, national home values fell by 0.7%. It was the sharpest single-month decline the market had seen in years, signaling a shift from a slowdown into a genuine correction. Sydney sits at the center of this downturn. In July alone, the city saw property values drop by 1.4%. Down south in Melbourne, properties fell 1.2%. The weakness is no longer confined to a single city. It is spreading through the eastern seaboard. We are watching a correction move through the capital cities, a market finding its floor as buyers reach the limit of what they can afford to pay. This creates a strange paradox. While property values are finally dropping, the actual financial barrier to entry has never been higher. The primary driver is the Reserve Bank. In the first half of 2026, the RBA raised the cash rate 3 separate times, taking it to 4.35% to combat persistent inflation. This chart shows the brutal reality for the average buyer. Those rate hikes stripped roughly 7 to 8% off total borrowing capacity, effectively lowering the ceiling for every new loan. That lost borrowing power translates directly to the auction floor. With less to bid, the final sale price is forced down. Auction clearance rates tell the same story. They have dipped to 55%, well below the decade average of 68%. The price drops in the major capitals are a mathematical reaction. In a high-interest environment, the market is constrained by a hard ceiling on credit. But buyers haven't left the market entirely. Instead, limited borrowing power is forcing a pivot away from expensive houses toward more affordable options. This pivot is creating a divided market. While the East Coast falls, Perth continues to see growth, supported by lower entry prices and strong demand. Brisbane is showing similar resilience. Even with high rates, houses here are hitting record highs as buyers look for value outside of Sydney and Melbourne. Adelaide remains the third in this growth trio. These mid-sized capitals hold value because they remain within reach for those with reduced borrowing capacity. We are seeing a structural shift toward units. As a more affordable entry point, apartments are now outperforming detached houses across almost every capital. The national market has fractured. It is now a competition between expensive capital cities seeing a correction and affordable regional hubs that are still climbing. There is one major exception to the cooling market. While property values fall, national rents are rising by nearly 6% a year. The National Housing Supply and Affordability Council identifies the core issue here, a massive shortfall in completions. We are currently 204,000 homes behind the targets set by the National Housing Accord. With vacancy rates under 1% in 5 different capital cities, renters have almost no negotiating power. There simply aren't enough roofs to meet the demand. Because the supply problem remains unsolved, the correction in property prices provides no relief for those in the rental market. This fragmented landscape changes the strategy for everyone. Whether you're buying, owning, or investing, the old assumptions no longer apply. For first home buyers, this is a window of negotiating power. With clearance rates low and stock levels rising, the leverage has shifted away from the vendor for the first time in years. Existing owners should ignore paper valuation drops and focus entirely on mortgage serviceability. Hardship provisions exist for those who act early, but cash flow is now the primary metric of success. Investors are facing the most significant change. The May 2026 budget introduced new laws that limit negative gearing on established homes bought after the announcement. By restricting tax offsets on existing properties, the government is intentionally pushing investor capital toward new construction. This makes the new build definition the most important factor in a modern property portfolio. The core drivers of Australian real estate, undersupply and population growth, haven't gone away. But the 4.35% cash rate has changed the math, forcing every participant in the market to prioritize cash flow over paper gains.